My name is Jake, welcome to the channel. In today's video, I want to talk about how many dividend stocks you should consider having in your portfolio. This video, I'm not going to tell you an exact number. I'm not going to say one way or another whether what's right and what's wrong. I'm just going to share with you information so that you can make the right decision for yourself. I've noticed a lot of things here on YouTube, just in general, like people, will search for a topic, and what I've noticed is there's always somebody out there saying you should do this, or you should buy this, or you should sell this. I don't really have any interest in sharing that kind of information on my channel. I want to give you the information so that you can make the decision for yourself. And I truly believe that there is no right or wrong answer when it comes to how many stocks you should own. I think there's a better and a worse answer, or when it comes to that, but I want to help you so that you can make the right decision for you. So if you go in the research section, you can look at your portfolio. For those of you that have been following the channel, you know that I have two portfolios. I have my cash flow portfolio and I have my real estate portfolio. And I allocated about 75-25, and I have a total of 38 holdings. 7 of these holdings are ETFs. So I have 31 individual companies. And the thing that I want to share with all of you is, yes, my portfolio value is down, but I'm not actually concerned about that. I'm actually excited about it because a large percentage of my overall portfolio are index funds. So when the index goes down, right, I get excited because I can buy in at a lower price. But here's the thing that I want to share with you. If I pull out my calculator, I think 2 or 3 weeks ago, it was at 480, right? So less than 0.5%. Now, I want to put this into perspective so that you understand why this makes me excited. Okay, so I invested, let's say you invested $100,000, last week or 2 weeks ago. This difference in yield is, 0.0036, so less than 0.5%. So every $100,000 that I invest today, I mean, I don't have $100,000, that'd be nice, but every dollar that I invest more, I'm getting a higher yield on cost. Okay. And so if I were to invest $100,000 today versus 2 weeks ago, give or take, I'm getting $360 annually more than I would previously. And so what does that equal out to on a monthly basis? On a monthly basis, you're getting about $30 more. And so for me, I like to dumb things down. For me, that's like getting Chipotle twice a week, right? I can get Chipotle, well, not twice a week, but twice a month, right? And if I were to have $200,000, I can get Chipotle every single week now, right? Like that's kind of how my brain processes these things. So every single time the market goes down, it's more Chipotle that I can buy. I know that's a weird example, but that's kind of how I think, right? Every time my yield goes up, every dollar that I invest, I'm getting more money, more return on that investment. And so when you see the market go down, as long as you're invested into stable businesses, cash flow positive businesses, this should excite you. Okay, but this is not the topic of the video. I think it's just so important that you understand when the market is going down, volatility, as a long-term investor, volatility is your friend. And so coming back to, diversification and how many stocks you should have in your portfolio, my perception on this has changed over the years. When I first started, using M1 Finance, I had upward of 100 individual companies in my portfolio. I know it was a lot and it was kind of crazy. But today I'm a little bit wiser. I've learned a little bit more. I've learned more about myself. And today I own about 31 individual companies and 7 ETFs. So I have under 40 holdings. And I'm going to share towards the end of the video why that is and why I personally, for a couple of reasons, decided to lower the amount of companies that I own. And whenever I see that somebody has over 50 dividend stocks in their portfolio, it always makes me kind of think of this. Oh my gosh, the ducks. All right, so that's a lot of ducks. So now what I want to do is, whenever you hear somebody bash on diversification, right? Somebody says, yeah, diversifying is for idiots. You shouldn't diversify your portfolio. I want to play devil's advocate here for a second and, kind of look at it from the other perspective. Well, why you shouldn't diversify or over diversify. Okay. And so whenever you hear, in the comment section, somebody that's trying to be smart and, pretend like they're smarter than they really are, they always quote Warren Buffett or Mark Cuban when it comes to diversification. So I want to play those clips here really quick. And I want to share with you, what the really the smartest people have to say about diversification.
All that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession, in our view, that you don't really understand the businesses that you own. The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs, because all they're going to do is own a part of America, and they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it.
So when it comes to diversification, in my mind, when it comes to a dividend portfolio, and when I look at just, my individual portfolios here, I have diversification across index funds, across industry, sectors, all of that stuff. And so something that I really try to live by, and what I always talk about on my channel, is if you're building out your portfolio, you want to kind of have guidelines, right? And so some guidelines that I like to live by is not having more than 5% into an individual company. I think that's one way you can get proper diversification. Now it's not the same with index funds. If you want to go well above that 5%, I actually think it's a good idea, right? Pick some of the best index funds and you can go heavier in those. I think that makes a lot of sense. And also with industries, not having more than 25% in a single industry. Okay, so that's kind of the guidelines that I live by. And so for me, when I look at portfolios that have over 50, 60 holdings, I think to myself, is that really necessary? Do you really need that? For many people, it's maybe a hobby. They're interested in it, or it's just hard, right? You look at all the consumer staple companies and you're just like, this one, and they're all great, and you just want to have them all, like they're little Pokemon, and you're just going out there and you got to catch them all. In reality, it's not always the best approach, at least what I have found. And so when I look at my portfolio, I look at every individual holding as for a purpose, right? It serves a purpose in my portfolio. Okay. And so when you're putting together a dividend portfolio, you want to understand why the company is in your portfolio. It's not just because, well, it's a cool company or I like it, but rather it has to serve some form or some purpose for it to be in your portfolio, right? And so here's the thing that I want to share with you that I think a lot of people don't really understand. So let's pull out my calculator here and let's do a little bit of math. I know not everybody loves math, but let's do some math. Okay, let's say, for example, you're a new investor, right? You're 20 years old, you're 30, you're 50, your age really doesn't matter. Let's say you're just started building out your first dividend portfolio, you're new, you're excited, and let's say you set a goal that you want to have a $1.5 million dividend portfolio. Okay, 1.5 million. So let's say, for example, you have a dividend portfolio of about 50 companies. And let's say each one of your slices are weighted differently. Each company is weighted differently. But let's say you have a slice in there that is 7%, right? Of the overall portfolio, it's 7%. And in that individual slice, let's say that you have 5 different companies in that slice. And let's say one of those companies is at a 10% slice. Okay, it's 10% of it. So that means that you have a 0.007% of your overall portfolio in that company. And let's say that company is Target. Okay, and let's say this is your target. So Target is going to represent 0.007% of your overall portfolio. And let's say in 20 years, you reach $1.5 million and Target represents this percentage in your portfolio. And so what we're going to do is we're going to times 1.5 million by the percentage of Target. And that means that you're going to have $10,500 in Target. Now, that's not a lot. I mean, it's not a little, but it's not a lot. Now, the numbers, if it's a large amount, small amount, it's all relative. But in 20 years, $10,000 might buy you a pizza, given where inflation is at. Maybe you can get some breadsticks and some sauce as well. $10,000, is not going to be a lot in 20 years. Okay, but let's also factor this in. Let's say that Target is paying a 2% dividend yield. So you got a 2% dividend yield. That means that Target is paying you $210. And let's assume that this is your yield on cost, right? Your yield on cost, $210 annually. Target pays a dividend 4 times a year. That means that you're getting a whopping $52.50 every 3 months, each quarter. $52. You can almost afford an oil change. And in 20 years, you can probably afford, one of those dangly things that, that helps your car, smell good. Those little trees. What I'm getting at is $52. I mean, do you really want to have 50 of these, 50 payouts of $50 in your portfolio? I don't know. All right, let's do one more example here really quick. Let's say, for example, you have 70 companies in your portfolio. You have 70 companies. And let's say one of your slices, your consumer discretionary, is 5%. So you got 5% of your overall portfolio. Now, let's say that you own McDonald's in that slice. And let's say that you have McDonald's, you have Home Depot, you have Target, you have a whole bunch of other discretionaries. Okay. Now, let's say that McDonald's also is 5% of that slice. That means you have 0.0025% allocated towards McDonald's. Now, let's say once again that you're building a $1.5 million portfolio. That means in 20 years, 15 years, 5 years, 100 years, you're going to have $3,750 in McDonald's. That's not a lot of money. Okay. Now let's also assume that your yield on cost is 2%. That means that you're getting $75 in annual dividend income from McDonald's. You can buy a Big Mac once a year with the dividend from McDonald's in 20 years. No fries, just a Big Mac and a small Coke. So on a quarterly basis, you're getting $18.75. You understand what I'm saying here? When you invest into 50, 60, 70, 100 companies, and you're building a $1 to $1.5 to $2 million portfolio, you're not really invested into McDonald's. $3,000 investment into McDonald's. I wouldn't really consider myself a shareholder of McDonald's with $3,000, right? And so that is why I dramatically decreased my number of holdings, because I really want to, when I go to Target and when I see Coca-Cola or when I see Pepsi products, I want to think to myself, hey, I'm a shareholder of Coca-Cola and I'm getting more than $5 a year in dividends, right? So when you're thinking about this, diversification, there can be many reasons why you diversify. But here's the one thing that I want you to understand. When you're building out your portfolio, so what you're seeing a lot of Excel, you're seeing a lot of numbers on your screen right now. I want to make this very simple. I have my cash flow portfolio. I have my real estate portfolio. All of my portfolios, this right here represents 100%. This is future state. This is assuming that we build a $2 million portfolio. If it's $2 million or $1.5 million, who knows, right? But let's say our target is $2 million. Over here, adding it all up, it's $2 million. That is why I want to have at least $30,000 in some of these companies. One, so that I feel like I'm a shareholder of the company, right? $30,000 in McDonald's is going to get me right around $173 a quarter in McDonald's, right? So what I did here is this is the future amount that I'm building. This is the ticker. This is the portfolio. This is all the portfolios. And this is the 4-year average dividend yield. And this is the 10-year CAGR, the dividend compounded annual growth rate. So if you wanted to do this with your portfolio, I would encourage you to do this. If you got 100 companies, 70 companies, write them all down, take, 2 hours on a Friday night and, listen to some music, go on Seeking Alpha. That's what I did. And type these all out and do the math and think to yourself, okay, do I really only want, $7,500 in Digital Realty Trust? Do I really only want $60 a quarter? And then if you take, I'm horrible at math, that's why I use my calculator, 60 times 4, do I really only want $240 a year from my investment? For me, the answer was a clear no, right? And so this is the beautiful thing, that $30,000 may be a lot or a little for someone. Everyone is in a different situation. Everyone has different expenses. If a lot for you is 10,000, do it. If a lot for you is 100,000, do it. But the key thing here is when you invest into a business, number one, understand that it's a business. Number two, understand that that business is working for you and generating cash flow for you as the shareholder. Isn't that cool when you think about that? When you own a piece of, Coca-Cola, every quarter, I'm going to be getting around $240 from Coca-Cola. All the employees of Coca-Cola work for me. And that $240 I can then use to go pay for my living expenses. Okay. So I would highly encourage you, if you're asking that question, how many dividend stocks should I own? Go through this exercise. Think in the future, okay, when do I plan on retiring? Or quitting my day job and living off of the passive income from my dividend portfolio. And then once you come up with your number, and if you don't have a number, that's where you got to start first, right? And you get your number based off of your expenses, your future expenses, and you got to use your best guess. But once you have your number and okay, I'm building a $1 million portfolio, a $2 million portfolio, a $59 million, whatever the number is, put in the number, see how many companies you have, do the math, right? Use the 4-year average dividend yield, because that's what you could reasonably assume if you're dollar cost averaging. And then take a look and see what your investments are going to be generating in cash flow on a monthly, a quarterly, and annual basis. And then make the decision how many individual dividend stocks or ETFs you want to own in your portfolio. Alrighty, folks, I hope that this was helpful. I hope that this helped you think in a different way when answering that question, how many dividend stocks should you own in your own portfolio? So here's the thing. Keep in mind that there's really no one size fits all answer. Okay. So that should immediately take away the stress of, when you're putting together your portfolio, there's really no right or wrong answer. The way that I look at it, there's a better and then there's a worse way of approaching this. And you really got to find out what's the right approach for you. But what I would definitely encourage you to not do is, after watching this video, don't go sell all your companies, right? Don't go sell half of your portfolio immediately. You don't want to get emotional when you're making this decision. Do the math. Think about it realistically. What's the situation that you want to have? How many companies do you actively want to follow up on a quarterly or annual basis? And just understand that when you do a search like this, like, you know, when you hear from other people, how many stocks should you own? They're in a different situation than you. Okay. So don't get intimidated. Don't get stressed and think that you have to have more or less. You have to find what's the right answer for you. And that's all that matters. Thank you so much for watching. I'll catch you in next week's video. We'll see you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.